Everyone talks about the 8% annual increase you get by delaying Social Security. And yeah, that's nice, but almost nobody discusses the hidden tax savings opportunity that could be worth even more than that benefit boost. I'm talking about a strategy that, if executed correctly, could save you hundreds of thousands of dollars in taxes over your retirement. This is something most financial advisors won't tell you about because, frankly, it requires looking at your retirement through a completely different lens. I'm Tony Matheson, a CFA and CFP with over 25 years experience helping families retire successfully. Today I'm going to show you exactly how delaying Social Security creates a window, a golden opportunity for massive tax savings through strategic Roth conversions. Chapter 1, the strategy nobody talks about. Let me ask you something. When you think about delaying Social Security, what's the first thing that comes to mind? For most people, it's that 8% annual increase in benefits, and rightfully so. According to the Social Security Administration, for every year you delay claiming past your full retirement age of 67 up to age 70, you receive an 8% simple annual boost to your monthly benefit. That's a guaranteed return that you can't get anywhere else. But here's what's fascinating. While everyone is focused on that 8% increase, they're completely missing the bigger opportunity sitting right in front of them. Between the time you retire, let's say at age 62, and when you start claiming Social Security at age 70, you have an 8-year window. And during these years, something remarkable happens to your tax situation. Your income drops dramatically. Think about it. You're no longer working, so you have no W-2 income. You're not taking Social Security yet, so you have no Social Security income. For many people, this creates the lowest tax bracket years of their entire adult lives. And this is where the magic happens. This window, this low income period, creates an unprecedented opportunity to move money from your traditional IRA to your Roth IRA at historically low tax rates. And the kicker? Most people completely miss this opportunity because they're too focused on the 8% annual increase from delaying Social Security. Chapter 2, how the tax window actually works. Let's get specific about how this works because understanding the mechanics is crucial to maximizing this strategy. Here are the 2026 federal tax brackets for married couples filing jointly. 10% on income from 0 to 24,800, 12% from 24,800 to 100,800, 22% from 100,800 to 211,400, 24% for 211,000 to 403,000. For singles, these ranges are roughly half. Now let's say you retire at 62. You're living off savings in a taxable brokerage account or cash reserves. You're not taking Social Security. You're not required to take distributions from your IRA yet. Those required minimum distributions don't start until age 73, according to the Secure 2.0 Act. This means your taxable income could be extremely low. Maybe you're only showing $30,000 or $40,000 in taxable income per year. At this level, you're sitting comfortably in the 12% tax bracket. Compare that to when you were working. You were probably in the 22 or 24% bracket, or possibly even higher. Here's the critical insight. This is the time to intentionally create taxable income through Roth conversions. Yes, you heard that right. I want you to pay taxes on purpose. But here's why it makes sense. Chapter 3, the Roth conversion opportunity. A Roth conversion is when you take money from a traditional IRA and move it to a Roth IRA. The amount you convert is added to your taxable income for that year. You pay ordinary income tax on it. But once it's in the Roth, it grows completely tax-free for the rest of your life. And when you take it out in retirement, you pay zero taxes on it. Now, under normal circumstances, people are hesitant to do Roth conversions because it creates a big tax bill. And that makes sense if you're in a high tax bracket. But during this window, when you're not working and not taking Social Security, you're in the lowest tax bracket you'll ever be in. Let me show you how the math works. Let's say after the standard deduction of $32,200 for married couples in 2026, Your taxable income is only $20,000. You could convert up to about $80,800 more from your traditional IRA and still stay entirely within the 12% tax bracket. That's nearly $81,000 moved from a traditional IRA to a Roth IRA, and you're only paying 12 cents on every dollar. Compare that to what happens if you don't do these conversions. Fast forward to age 73. Now you're required to start taking minimum distributions from that IRA. Your IRA has been growing for 11 years. Now let's say it's doubled. Now you're forced to take out large distributions, whether you need that money or not. And those distributions are taxed at your ordinary income rate. But wait, it gets worse. You're also taking Social Security at this point. Up to 85% of your Social Security benefits can become taxable depending on your other income. So now you've got Social Security income, plus these forced IRA distributions, and suddenly you're pushed into the 22% or even 24% tax bracket. This is exactly what happened to a couple we'll call Bill and Lindsay. The names are changed, but an example from a real couple that I worked with. Chapter 4. Real client example, Bill and Lindsay's $300K tax savings. Bill and Lindsay came to me when Bill was 62 and Lindsay was 60. Bill had been managing a remote team in the tech industry for years, and Lindsay had spent most of her career in nursing. They'd done an excellent job saving, accumulating equity in their home, and building up significant balances in their 401k plans. Between the two of them, they had saved diligently in pre-tax accounts, and Bill had some company stock through his employee stock plan. They wanted to retire soon, but they were concerned. They were both earning six-figure incomes, which meant they were in a high tax bracket, and they worried that when they retired and started withdrawing from these accounts, the taxes would eat into their savings significantly. When we ran their numbers, I told them something that surprised them. They could both retire safely in just 2 years. But more importantly, I showed them a tax strategy that would change everything. Here was the plan. They would both retire at ages 64 and 62 respectively. We would delay both of their Social Security benefits until age 70. This gave us a window of 6 to 8 years where their income would be dramatically lower. During these years, we would systematically convert portions of their traditional IRAs and 401ks to Roth IRAs. Each year, we carefully calculated how much to convert to fill up the lower tax brackets, primarily the 12 and 22% brackets, without pushing them unnecessarily into the 24% bracket. We targeted converting enough to stay near the top of the 22% bracket, which for married couples in 2026 tops out at $211,400 of taxable income. Over those 6 to 8 years, we systematically moved several $100,000 from their taxable traditional accounts into tax-free Roth accounts. Yes, they paid taxes on those conversions, approximately $15,000 to $25,000 per year, depending on the amount converted. But here's what we avoided. When they turned 73, instead of being forced to take massive required minimum distributions from multi-million-dollar traditional IRAs, which would have pushed them into the 24%, 32%, or even higher tax brackets, they now have much smaller traditional IRA balances. The bulk of their retirement savings sits in Roth IRAs, growing completely tax-free. When we ran the lifetime tax projection, comparing the scenario where they did nothing versus the scenario with strategic Roth conversion, the difference was staggering. We projected lifetime tax savings of several $100,000. In their specific case, the savings exceeded $300,000 in today's dollars. But it gets even better. By delaying their Social Security until age 70, their monthly benefits increased by 24%, compared to claiming at their full retirement age of 67. This created a guaranteed income stream for life that was significantly higher, further reducing the need to draw heavily from their IRAs later in retirement. Bill and Lindsay were relieved. They now had a clear plan to retire in 2 years. They knew exactly how to manage their taxes efficiently, and they had peace of mind knowing they'd optimized their retirement income strategy. Chapter 5, the 3 factors that determine if this works for you. Now, you might be thinking, this sounds great, Tony, but will this work for me? That's the right question to ask. This strategy isn't right for everyone, and there are 3 critical factors that determine whether it makes sense for your situation. Factor number 1, your income sources. This strategy works best if you have sufficient assets outside of your traditional IRA to fund your living expenses during those years between retirement and when you start Social Security. This could be money in a taxable brokerage account. Roth IRA contributions you can access penalty-free, or cash savings. If all your money is locked up in traditional IRAs and you need to take distributions just to live, then you don't have the flexibility to do these conversions. Factor number 2, your account balances. The bigger your traditional IRA balance, the more impactful this strategy becomes. If you have $2 million in a traditional IRA, the required minimum distributions at age 73 are going to be substantial and taxed at your highest rate. But if you only have $100,000 in a traditional IRA, the RMDs might not push you into a significantly higher bracket, making the conversions less critical. Factor number 3, your tax bracket analysis. You need to look at where you are now versus where you'll be in the future. If you're currently in the 22% bracket while working, and you project to being in the 12% bracket after retirement but before Social Security, there's a compelling case for waiting to convert during retirement. But if you're already in the 12% bracket while working, converting now might make more sense than waiting. The key is running the numbers specific to your situation. This is why working with a financial advisor who specializes in retirement and tax planning is so valuable. We use sophisticated planning software to model out different scenarios and see which strategy produces the best after-tax outcome over your lifetime. Chapter 6, Common Obstacles and How to Overcome Them. I'd be lying if I said this strategy doesn't come with challenges. Let me address the most common obstacles that I hear from clients, and more importantly, how to overcome them. Obstacle number 1, I don't want to pay taxes now. I get it. Writing a check to the IRS is painful. Nobody enjoys it. But here's the reframe. You're not paying more taxes. You're choosing when to pay them. And you're choosing to pay at 12% or 22% instead of 24 or 32% later. Think of it like this. If you could buy something you need at a 50% discount today or pay full price later, which would you choose? Roth conversions during low income years are that discount. Obstacle number 2, what if I need that money in my IRA? This is about liquidity concerns. The good news is that Roth conversions follow the 5-year rule, but it only applies to earnings. The principal, the amount that you converted, can be withdrawn at any time without penalty once it's been in the Roth for 5 years. And if you're over 59 and a half, you can access it even sooner. Plus, remember, we're only converting what you don't need for current living expenses. Obstacle number 3, what if tax rates go down in the future? This is a valid concern, though frankly it seems unlikely given our national debt levels. But even if tax rates do drop, you've locked in your rate through the conversion. And remember, you still have the benefit of tax-free growth on those converted dollars for potentially decades. Even in a lower tax environment, that tax-free growth and tax-free withdrawal provides tremendous value. Obstacle number 4. This sounds complicated. It is more complex than just doing nothing. But that's exactly why most people miss this opportunity. They take the path of least resistance, which costs them hundreds of thousands in unnecessary taxes. The complexity is actually your advantage because most people won't do it. You can benefit tremendously by taking the time to do it right. And here's the most important part. You don't have to figure this out alone. This is exactly the type of planning we do for clients at Slalom Wealth Management every single day. We specialize in helping families over 50 navigate these critical retirement decisions. Look, delaying Social Security to age 70 is a smart move for the 8% annual increase. But if you stop there, you're leaving potentially hundreds of thousands of dollars on the table in unnecessary taxes. The strategy I've shared today, using that low income window between retirement and Social Security to do strategic Roth conversions, has transformed retirement for clients like Bill and Lindsay. It can do the same for you. But this isn't something you want to guess at. The details matter. The timing matters. How much you convert each year matters. This is where working with an experienced retirement advisor makes all the difference. As a CFA and a CFP with over 25 years of experience, I've guided hundreds of families through this exact planning process. If you're approaching retirement and want to make sure that you're not overpaying the IRS, I invite you to download our free retirement assessment resource or schedule an introductory phone call with our team at Slalom Wealth Management. You can find the link in the description below. We'll analyze your specific situation, run the projections, and show you exactly how much you could save in taxes by implementing this strategy. Remember, retirement planning isn't just about having enough money. It's about making the most of every dollar you've worked so hard to save. Let's make sure you keep more of your hard-earned money and less goes to Uncle Sam.